Before we start the show, Andy, I'd just like to say a quick thank you to our podcast sponsor, Wealth Simple, one of the leading online investment platforms globally. Now, Wealth Simple manages over £3 billion for more than 200,000 customers. Wealth Simple prides itself on providing access to smart, simple investing without the high fees and account minimums usually associated with traditional investment management. In fact, you can open a stocks and shares ISA, a SIP or a junior ISA with as little as £1, which is far lower than any of its peers, and every client has access to unlimited human advice from a qualified investment advisor. Now, Wealth Simple also provides ethical investing options and produces an online magazine in an attempt to demystify the world of money. Money to the Masses podcast listeners can get their first £10,000 with Wealth Simple managed free for a year if they sign up at wealthsimple.com/money to the masses. You can also check our full review of Wealth Simple online at moneytothemasses.com.
Hello and welcome to episode 273 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, welcome back. How you doing?
I'm good. I'm actually feeling incredibly upbeat and motivated. The reason is one of the reviews we've just received on the podcast. So every week, well, we don't do it every week. We should do it more than we do. We ask for reviews of the podcast, and we should do this every week, saying, please, can you give us a review on whatever app you use. I know that a lot of people use iTunes, so I tend to look at the reviews that are in there, and we received an absolute cracking review on iTunes. I mean, Andy's going to read it out in a second, but I just want people to realise that the effect of having such great reviews that get posted, because it allows us to know that we're doing the right thing, that people like what we're doing, and it's also having an impact, and it's changing people's financial lives, which for me is the whole reason I do this. So it's a real buzz. I mean, Andy made the point, if I was going to write a review myself, it would have probably sounded like the review he's about to read out. So Andy, over to you.
Okay, so this is from Kevin. This is the first money podcast I started to listen to, and it is still my favourite. The weekly article format always gives you something to think about or do, and by implementing the ideas put in place by Damien and Andy, I've been able to make my money work for me like I would have never believed. There have been some quick wins, for example, £1,800 back from HMRC as a higher rate tax relief on pension contributions, and some slower, more impactful changes. For example, pensions invested aggressively for retirement in 20 plus years' time and then left alone as they've risen and fallen over the last few years. The podcasters aren't precious and will point you in the right direction of resources that are better than their extensive library, if they indeed exist. If you are like I was 3 years ago and need to give your financial life a major overhaul and focus, you need to listen to this show now. Thank you both. I mean, that's pretty amazing, isn't it?
I love that, because as it mentions, there's some easy wins. We do this podcast and we cover a lot of stuff, and there are things they don't know, so it's that serendipity about it, which is why the show's structured as it is. So there are things you'll just stumble across, and as Kevin said about high rate tax relief, so people who end up saving or making money along the way through just a piece on the podcast, but then that longer term, more impactful stuff. It's a real buzz to get a review like that. So if you can leave us a review, as you can clearly hear, it really motivates us. I mean, it doesn't have to be as amazing as Kevin's. It can just say that you like the show, but please do so.
And of course, if you ever want to feedback about stuff that you don't like so much, or stuff you'd like to hear, then do get in touch with us by email, because that's the quickest and easiest way for us to be able to look at that and actually, be able to react to that. So that's Damien at moneytothemasses.com. Essentially, what I'm saying there is, if you've got something negative, don't put it on the review.
One of the things Kevin mentions there before we move on is that idea of pointing to things out there, other resources where they exist. And it's an important point, because we don't all know everything. And a lot of what we do when we're trying to teach people is sometimes pointing people to resources that are very good, like Kevin mentioned, that may be better than what we can provide or have already provided. Because don't forget that it's a bit like being a librarian. A librarian doesn't know what's in every book within a library, but they do know where the information is that you might need to help you. So it's kind of like being a librarian, or another analogy would be a lighthouse, that you're sort of attracting the sort of best ideas, and we'll be able to help people with their money. So on that note, I suppose the next question you're going to have for me, Andy, is what's on the show.
Yeah, so what have we got coming up on this week's show?
So this week, the 3 pieces will be covering investing and an analogy. So last week we did an analogy that was about a goalkeeper that proved very popular. Anybody who listens to this show will know that I'm very fond of an analogy. I sort of often just veer off into one to try and help describe a situation, help people understand. But there's one I want to talk about that I was pondering the other day that just suddenly popped into my head regarding investing and to help people have a greater chance of being successful at it. The other piece I want to do is about the things that DIY investors, so ordinary armchair investors, the advantages they have over professional investors. So it's a positive, upbeat piece, because the first piece which is going to be a bit of an analogy, showed people and talks about how you get investing, or when people are investing, how to do it better. But this second piece is really giving people the belief that they can do it themselves. And the last piece I'm going to hand over to you, Andy, and you're going to do something on computer games.
Yeah, so Jordan's done another great article for the site, and by the time you listen to this podcast, the article will be there, and we'll mention it later on in the podcast. But I'm going to be looking at the games that are sitting, gathering dust at the back of your cupboard, whether it's you, your children, or maybe even your brothers or sisters are no longer playing and they're just gathering dust. And so, yeah, it's a quick piece on looking at which games will actually end up netting you quite a lot of money if you trade them in.
So that's Jordan Cox, aka the Coupon Kid, who was a very popular panel member at our live event at the back end of last year. So that's definitely worth listening to. So I'm going to start with the investment piece and the analogy that I want people to listen to and understand. So like I said, last week was the goalkeeper analogy. This week, I want to talk about investing, but with reference to taking a car journey. Now, I get a lot of questions throughout the week and on Facebook, email about investing, and people are normally at different stages of the investment journey. And some of them will be about what to invest in, how much they should invest, how much they might make, about risk, about assets. And it's quite a concoction of questions. And it was that word I mentioned there, journey, that got me thinking. And investing is fundamentally a journey. And what I want people to think about is investing as a car journey. And it will help them to understand my thought process when I try and answer these questions for people. Investing is very much like a car journey. And by that, I mean that you need to fundamentally know where you want to go. So before you go out on a car journey, you normally decide on a destination. So let's say we're starting down here in London and we're heading off up somewhere up north. Let's go to Scotland. Now, there is definitely a thought process that goes on when you're deciding that you're going to go to Scotland. It's an ultimate why. So maybe you're going to a wedding or something like that. Then it starts to lead on more to the how. How are you going to do it? And leading on from that, you start to think about, well, the modes of transport you might use. So already, by understanding the sort of what and why you are traveling, it starts to inform how you're going to do it in a decision-making process. So if you take that and think about the comparison with investing, if you start to invest, then it helps if you know why and what your goal is. Now, you don't have to have a goal with investing, but your chances of succeeding are much higher if you do, because it starts to inform the decisions that you have. And one of the things that I also like about the analogy of a car journey, travelling from London to Scotland is fundamentally quite a complex task. It seems it from outset, but people can do it subconsciously. That's how easy it can be, because we all start out when we learn to drive. Driving, I remember, seems the most difficult task when you first learn. I mean, I didn't pass. I don't know about you, Andy. I failed my first test. I ended up taking 2 attempts to pass my test.
Yeah, I was a second timer. all the best drivers clearly pass second time round.
And I didn't actually pass until I was about in my early 20s. I was about 22, 23. You were even later than that, weren't you, Andy?
Yes, thanks very much for bringing that one up. I was about 28, 29, I think, yeah.
Yeah, so like all of these things, actually, by doing it probably when you've got a bit more experience, actually helps a bit, I suppose, a bit like investing. But the point is that when you start to learn to drive, it's quite difficult. But very quickly, you learn it's actually far easier than you thought. And ultimately, it becomes a very subconscious act. So you could get into a car and you don't think about that you're changing gear and what's going on. You're just doing it. And investing can be like that. Investing doesn't have to be difficult. It isn't this sort of mythical thing that people think it is. And some of that is down to the industry. They like to give the impression that it's far more difficult than it is. It helps them to keep their margins and to charge you lots of money to do it for you. So you are much more likely to be successful if you actually have a destination in mind, the reason of why you're going somewhere and where you're going to. And I'll explain a little bit more later on why, if you don't have a destination or a reason in mind, why you might not be so successful. So if we think about that journey you're going to make, so you're starting to invest, you're all excited, you've got some money, I want to start investing. And it's a very popular question and statement I get. What should I do? Now, if you are driving, you would automatically work out what time you need to be at that place. So let's assume it's going to be a date in the future, but there's a set time. So the idea of a wedding works quite well. You're then going to sort of plan around that, where you're going to go. You might stay in a hotel, but then you start to work backwards from that, because you obviously need to work out how long will it take you to get to that destination. And if it's going to take you 5, 6, 7 hours, that will dictate at what time you're going to leave in the morning. But not only that, it starts to dictate perhaps the mode of transport you'll use. Now, in the investing world, think of the mode of transport perhaps like the getting someone in DIY route. So you might go public transport, so something where the costs are shared, it could be cheaper, but you don't have a lot of control over it. That doesn't mean you won't get there. You will ultimately still get to the same place you want to, but it may be a slightly different journey. But you are sitting back, relaxing, reading your magazine, drinking beer on the way up. If you decide to do it yourself, you're much more in control. The cost could be higher, doesn't necessarily have to be, but it's going to probably be a lot more stress. But the destination is probably going to be the same. It's ultimately you want it to be the same, but you've got more flexibility, because if something goes wrong, then you can make a change to that journey. Something goes wrong on the trains. I mean, how many times have we all been stuck on a train from one part of the country to another? I know Andy did not long ago, actually, where you are stuck for hours and you get dumped on the side of the train track almost at some random station in the middle of nowhere and told, right, make your way home. And you can't, because you've been put somewhere where your options are now limited. Investing is very much like that. So if you've got the DIY route, that means going to choose the investments yourself. Maybe you're going down the route of you use a platform, whichever one it is. You've got a lot of flexibility about the assets and things that you want to buy. You go down the sort of get someone in route. It might be a robo-advisor. You might have a financial advisor. So that will cost maybe more money, but you have less flexibility because you're doing kind of what you're told. You could travel first class. That might be going down the advisor route, but fundamentally you're ending up at the same place. So you can argue whether it actually gives good value. So the analogy, no analogy is perfect, but I think people can start to see the parallels of what I'm talking about. But of course, once you start to think about where you want to go, then the time, like I said, to get there becomes important. If you're going to do it yourself, so you're going to drive, you've got to plan the journey, the route, and you're going to have to work out the speed you're going to travel. So you could decide, like I know some people who go, oh yeah, I get from here to Sunderland in about 3 hours. And you're sitting there thinking, what speed are you driving? And they go, I don't care, I got up the M1, and they break all the speed limits. If you do that, you've got a more chance of things going wrong. You're going to get a ticket or crash. The same thing with investing. You could try to get to the destination you're trying to get to. It may be the destination is a certain sum of money. It might be a certain, might be retirement. Whatever that goal is that you're trying to do, buy a house, whatever. If you try and get there quicker, then you're going to have to take more risk, aren't you? And that ultimately is where you could come a cropper, because the markets could crash. But that is something, if you're going to drive fast, you've got to accept the possible outcomes. And so in the investing world, you've got to choose your risk, you've got to choose your asset class, you're going to choose if you're going to do it yourself. Now, if you start to do it yourself, or you're traveling, whichever route you go down, one thing you've got to focus on is where you're trying to get to. So if you're starting to invest, whichever route you choose, whether it's going down the get someone in route, robo-advice, financial advisor, or you do it yourself, so you get in a train or driving, as long as you're traveling at the speed that you need to get there on time, everything's running to clockwork, you're okay. The key thing is to keep an eye on that speed, because what a lot of people do is they focus on the return that they get during different parts of the journey. So if you're on a train or a car, and particularly in a car, you might hit a traffic jam. So you may be traveling up to the country and you hit a traffic jam around Birmingham. We always do this. You get stuck in a traffic jam. You might plan for that, but equally, you might have to make up for lost time. So you might have to make adjustments on your journey. But what you have to realize, as long as that is built into your plan, you left early enough. You started investing early enough. You started to pay enough contributions to achieve your plan. Then any disruption can be taken into account. So that might be a sell-off in the market or whatever. So you don't have to fundamentally change anything. You just sit there and think, I've still got enough time. I'm still making a steady 60 miles every hour, even though I'm stuck in this traffic jam for 20 minutes because I had a good run all the way up to this point. So that is the benchmark that I often talk about with people, is that when you might get a year the market's up 20% and you're punching the air, you've got to realize there's going to be a year around the corner where your portfolio falls 20%. But it doesn't really matter if you're still up at you may need 5 to 8% a year growth to hit your target. As long as you're still above that line on average going along, it doesn't really matter about the traffic jam along the way or the sort of clear road, or whether you use the toll road or whatever it is. It's about making sure you're still on time. And so when you get an investment plan, you're trying to say build a £200,000 pension pot, and you have got a certain amount of money you want to put in. When we've got a calculator on our site, just go on the site and look for a pension calculator. It will calculate for you what sort of pension pot you'll have given certain inputs you put in, maybe how much money you put in, how much your employer puts in, when you want to retire, for example. And then you can adjust those inputs to work out, actually, I need to put in a bit more, which is the equivalent in my analogy of I might need to drive a little bit faster or have to increase the amount of investment return that you need and therefore take a bit more risk. But you don't want to break the speed limit. You don't want to become reckless with your investing. So you don't want to take excess risk, anything you're more comfortable with. Because if you're anything like me, I'm not a great passenger. I don't want to be in a car where someone's driving 90 all the way just to get there a bit quicker. So the other thing to realize, the reason I mention this benchmarking, is that when you're trying to travel to somewhere, so you're trying to get to this wedding, you're not bothered what everybody else on the motorway is doing. If you're sitting in the train carriage, you're not bothered where everybody else is going and whether they're going to get there on time. So this idea, it's a journey. It's not a race. So you've got to just focus on what you're doing. So yes, there may be other people who might be shouting about the brilliant return they've got year to date or in the last couple of years or on the rebound of the market. It doesn't matter. And half the time they only sing about the wins they have. You've got to focus on what you're doing. So do try and work out what your benchmark is. It may be that you reverse engineer where you need to be and the amount of money you can put in using calculators like I mentioned that's on Money to the Masses or any others that you find out there. And you can work out what sort of rate of return you need to get a year. And it may be 5, it may be 10% or whatever it is. That will start to dictate the assets you use, because obviously you're not going to get 10% a year if you only have your money in cash or in bonds. You're only likely to get that if you start taking more risk, and that means equities. Now, of course, like anybody, when you're traveling, you're going to review where you are. Okay, we're on time. Okay, we need to go a bit faster or whatever it is. And it could get to the point where you start to realize you're not going to get there possibly at all, or certainly not on the right day. And that being late may be that you decide to change transport. For example, you might suddenly get near to where you need to be. The train's stopped, you get out the next station and you get a cab. It might cost you a bit more money, but you end up getting there. I've done it on the way to football one time. I remember we were trying to get to Tottenham versus Man United, and we left so early, and my dad loves leaving early. So we were near Manchester with hours to spare, but then there was the mother of all traffic jams to the point that we only got in towards near where Old Trafford was with about 20 minutes before kickoff. So we ended up parking anywhere and then just running, because it was going to be quicker to run to our destination to get there on time. And so you may have to do that. You might have to change, but that's part of reviewing it. But one of the other things is, of course, if you're going to be late, the other choice you have is to ring up and say, I'm going to be late, and change your reservation or something like that. Or you can't delay a wedding, but if it's just being in a hotel, you could change your reservation or whatever it is. You can do that in the investment world. That could be you're not going to hit your pension pot size that you want, so you can retire with the amount of income that you want in retirement. So you delay retirement, or you might be getting there early, and therefore you might decide, you know what, let's go for breakfast beforehand before we actually go to the final destination. So in the investing world, that might be that your pension pot or your investment size has got to something that you actually wanted to sooner. Therefore, you can start to ease off, take it easy, have breakfast, i.e., maybe take a little bit less risk or something like that. So it's the same analogy, but I want people to start to realize if you do things with a very deliberate purpose, you've got much more chance of getting there. Now, the analogy works because what it does is it illustrates to people that you have control over a lot of this stuff. And the decision you make at outset can be changed on the way. It isn't set in stone. You don't have to keep following the original route if it's not working. I mean, it doesn't mean you're going to have to keep going around in circles and keep changing it, but you don't have to keep changing the route. And sometimes for some people, they may prefer just sitting on a train and traveling that way. That's okay. Let the people who want to get stuck in traffic jams and be there a bit quicker because they like to do it themselves and go by car. It's a personal choice. It's not a race. You don't have to compare yourself to somebody else. It's not one route is necessarily better than the other. Ultimately, you might all end up at the same wedding and having the same fun, but you did it in your own way. Some people may be more stressed, others less so. It's a personal choice. The other thing is you have a control over cost, which this gives you. And at the beginning of the piece, I wanted to mention about the idea of not having a destination. If you leave your house and go, I'm going for a drive, almost certainly the place you'll end up is back where you started because there was no aim to it. It was aimless. And all you've done is succeeded in spending money. Maybe you had a bit of fun while you were driving around, but ultimately you didn't achieve anything. So if you're trying to invest to achieve something, it is much more likely to be successful if you state what that goal is, because then you can reverse engineer it, just like you reverse engineer every journey you go on to try and get there on time. The other thing to bear in mind is that most journeys are not done on their own. So you're not doing it as a sole person. So you may be going somewhere and you may be going with your other half. So your partner could share the driving or the cost or friends or whatever it is. And investing is very much works the same way. So don't forget, if you're trying to get somewhere, you've got to take into account your wider circumstances. So it may be your partner's allowances, your partner's assets, and those sorts of things. So it is something that can be used. It's not just you getting there. You're trying to get you and your family to somewhere. And if you think of it like that, you start thinking about your money in a slightly different way. So that was my analogy. It was quite a lengthy analogy. No analogy is perfect, but hopefully what it does is it makes people realize that they've got control, makes them feel a bit better about it, and realize that it's not about perfection. You're not trying to be the perfect journey from here to Scotland. It doesn't exist. It doesn't really matter. It's what works for you. And then you're not trying to compete and compare, but you're focusing on trying to achieve it. And if you do that, you're much more likely to get there.
Good stuff. And so keeping on the investing theme, we're going to be looking at the advantages that you have over a professional investor.
So this is really a piece that's meant to give people optimism and the confidence that they can do this stuff themselves. They might not want to, as I mentioned in my analogy, but people have always been led to believe that investing is only for the wealthy. And in fact, until recent history, it was. You couldn't really invest in shares and things like that unless you had a stockbroker who would cost a lot of money. But the amazing thing about the internet, about technology, and also competition is that it's driven down the cost of nearly everything when it comes to investing, and it has caused a lot of innovation that means that it's democratized it, so anyone can do it. So where you would need maybe tens, hundreds of thousands of pounds to invest in certain assets, now you can do it from as little as 50p. I mean, that's incredible. But what I want people to realize that investing isn't as difficult as people think. I know everyone can make mistakes, even professional investors. But what I want to highlight to people is that professional investors, that's their job, to invest people's money, but they're not perfect. And so when I'm talking about professional investors, it may be fund managers, it may be a financial advisor who tells you that he knows how to invest your money best, or she. And here is a list of just some of the reasons why you can do better than they do. So first of all, there's no conflict of interest. So imagine that analogy I spoke about earlier, and I said that the first class carriage might be the financial advisor route. Then don't forget, in my analogy, that financial advisor is probably working for the train company. So he's getting paid by making sure you go on that first class carriage. And a lot of the financial world has a conflict of interest, or certainly has done historically. It is improving because of some of the work by the regulator, but it's had a conflict of interest where they are paid in a way that only occurs if you take certain actions that they recommend. So previously it was commissions on certain products. It might be a fee that they charge if you take a certain course of action, but it has therefore limited the range of products they would recommend, or even now where some of that has been removed in terms of the bias in the way they're remunerated, their expertise is insufficient in areas that didn't previously pay them. So there aren't conflicts of interest that occur. I mean, it's very rare that you'll get a financial advisor, or the good ones do, but a lot of financial advisors may not point you in a direction. If you're a multimillionaire and there's someone down the road who do a better job than they would with your money, then it's very unlikely that they would point you down that road, because you are a massive pot of money to them that they can take a slice of. And so that conflict of interest does mean that they won't necessarily have your best interests at heart. Fees is one of them. You can cut fees down to like a slither as a private investor. Yes, professional investors have economies of scale, but you still have to pay them and their fees. You can remove that if you want to, because there are services out there that do fundamentally the same as them, might give you a standard portfolio, a balanced portfolio of some kind. For example, the robo-advice propositions out there, or something like Vanguard, they may have a portfolio or fund that pretty much does the same thing at a fraction of the cost. I mentioned the range of assets or products that they may not invest in. One of the things in the financial world is they tend to over-specialize, and so you'll get an equity fund manager and he'll know everything about equities, so he'll only invest in equities. But actually, there may be other assets out there that are far better and have performed far better over a longer period of time, that you'd have made more money in if you'd invested in them. But of course, if that fund house doesn't have that expertise, then you're not going to be exposed to it, and neither is your portfolio. So what it means is, as a private investor, as a DIY investor, you can fundamentally invest in almost anything you want now at a cost-effective price. So you could go and invest in gold. You could go and invest in bonds and equities, or all around the globe in all of those assets. And it means that you've got a greater chance of diversifying your portfolio, which is important, but also potentially making money even in a market where there's a downturn. Career risk you don't have. So as a DIY investor, as a private investor, you don't have a career risk. And by that, I mean a fund manager will get sacked if he or she underperforms the benchmark. And that benchmark is sometimes one that they pick, but typically, as long as they're within the herd, so all their peers, if they're all doing as badly as each other, that's a fine, because they can just point to everybody else that we're outperforming most of those other people. But what you really want is somebody who's going to make money even when others are losing money. And that takes a lot of conviction and a lot of guts. But of course, they could be right. So they could be betting, like it happened at the dot-com crash. There was a famous manager that was nicknamed Dr. Doom, who famously didn't want to invest in technology stocks, was at the bottom of the pile, got sacked by his employer. And then about a month or so later, the market collapsed and his fund went from bottom to top, but he'd already lost his job. So you can have periods of underperformance, but it takes a lot of guts. He actually would have kept his job if he just copied everybody else, and then he would have lost a lot of money in the dot-com crash for all of his clients. And that's what tends to happen. But as a DIY investor, you don't have to do that. It's your money. You can choose whether you want to invest. You can choose whether you think the market is looking expensive and bail out. Of course, with that comes risks that you make decisions that may lose you money, but it is your money. You are in control of that car journey where you want to go. And that's what's the most important thing. It doesn't matter if you didn't get all of the upside, but if you miss some of the downside, then you may be particularly pleased, but it doesn't matter. It's your money. There is no optimum return out there. Everything outperforms, underperforms at different times. You can also, as a private investor, have a view, a fundamental view or a technical view, whatever it is, how you formulate your opinions. You're not constrained by one or the other. And there's a typical example is fundamentals or technical analysis. So technical analysis, people hear me talk about some of that on midweek markets, where it's like the ups and downs, there's the lines of resistance and support that the stock market tends to bounce up and down and between, which can give you a bit of a steer to where the market might go in the future, a bit like a weather forecast. But fundamental economics will say, like right now, the coronavirus has absolutely decimated the economy, then everything's going to crash. But technical analysis at the moment is saying the opposite, because it's just based on price. But people tend to have one view or the other in running money. They very rarely look at both sides of that coin, but you can do as an investor. And that can mean that I know some people who did as private investors who wrote into me and said, on 80/20 Investor, in fact, they made a decision that they thought, He wanted to get out of the market because it was looking, in their view, they thought that the coronavirus was going to explode. And that was in February before it did. And they bailed out of the market. They had that ability, as they are DIY investors that can do it themselves. A fund manager doesn't. They're compelled, if they're an equity fund manager, to keep investing your money because that's what they're paid for. So you can look at whatever fundamental technical analysis you want and you can formulate an opinion. But it's your opinion, it's your money. And of course, you can take long-term views on things. So in a market crash like this, you don't have to worry that the market's fallen, because you're taking a 15, 20-year view. Like Kevin mentioned in his review at the beginning of the podcast, he's got a long-term view, so he's able to ride that out. As a fund manager, it's very different because you are now bottom of the pile and you've got to try and claw that back. And that may mean you start to make decisions that could harm you going forward. You might start chasing the market to try and unwind losses. And actually what you do is just make the problems worse. So they are a range of things that you have over a professional fund manager. Of course, also you can go into cash. A fund manager won't go 100% cash. Now, I'm not saying you'll necessarily do that, but you have that option. So that's why I wanted to join the analogy with the drive-in with this piece, just to show people how much control they have and how it could be that they go and buy a particularly cheap passive fund. An active fund manager or financial advisor is unlikely to recommend you passive funds. There are financial advisors out there who do like them. I know there are. But fundamentally, it kind of goes against the grain of what they're saying. Because if somebody uses passive investment, but then whacking a 1% charge every year on top, you start to think, well, what's the point in me paying you as a financial advisor? Where financial advisors come into their own is the planning part. They do. That's where the value is. So it may be you've got a very complex set of financial circumstances, estate. They can unravel that. It can do with tax. They can help you build the plan. So it's about value. And of course, like I say, for a financial advisor, it may be that they recommend a passive investment to you. You might not want to pay their fees on top going forward. That's obviously a decision that you'd have to take. So the message is there are a lot of things out there now, whether it's robo-advice, whether it's passive investments, whether it's DIY using a platform like Hargreaves Interactive Investor, and information out there that means that you can do as good a job as a professional investor. You just need to learn and educate yourself if you want to go down the DIY route. There's plenty of great books and podcasts and things like that out there. If you want to know more, go to our Facebook group. Actually, there's a brilliant post in the early days that somebody put out there asking about books to read on money and investing. There's some great books in there so you can educate yourself. But anyway, I'll shut up now, Andy. I've just noticed the time I've been going on. I've got carried away enjoying myself too much.
That's all right. I enjoyed listening to it. That does take us into the last piece, which is it's kind of like chalk and cheese. You were talking about some fairly sort of complex investments. Well, not complex, investments. And now we're going to be talking about Mario Kart. So
I love it because that's what I was playing last night, Andy, Mario Kart. So we need that. You need your downtime. That's why I like these pieces on the podcast from time to time. We need our downtime.
Exactly right. So the last piece really is just a bit of throwing a spotlight on those things that you forget about. You chuck into the back of the cupboard and you think, well, they'll never be worth any money. They'll never get used again. And you're probably thinking in the back of your mind, you'll take it down the charity shop or even worse, they'll probably end up on the scrap heap. But those games that are at the back of your cupboard, gathering dust, they can be worth money. And Jordan Cox, who we mentioned earlier in the podcast, has written a brilliant article that highlights all of the games that will actually net you a pretty penny if you trade in, even now in 2020. Now, Damien, I'm talking about games that are over 10 years old and are on old platforms such as the Nintendo DS, the old NES, all sorts of different games. Do you reckon you've got any cluttering up the back of your cupboard?
Yes, I'm intrigued by this. I haven't read Jordan's piece yet, so I will do, because I've got all of my old computer consoles, games. My mum was always a hoarder. I'm somewhere, I've still got the Commodore 64, the original Commodore 64 from back in 1980s when I first ever played on a computer. That still exists, and I think it probably still works. So yeah, I mean, I've got them, so I'm intrigued.
Well, I was in this position a few years back, and I started to look at what certain things were worth, and it kind of depressed me a little bit. I remember spending about an hour going through various different things online and using a service, I think it was called Music Magpie, where you can put sort of old albums and CDs and old games, and I was getting back like 10p, 20p, 30p, and then when you factored in the postage costs, it wasn't worth doing. Well, Jordan has highlighted actually that people like Music Magpie, and there's another service that's called We Buy Games, are probably best avoided. They aren't going to be where you're going to make your most money. So stop looking at those ones and look at high street chain CEX. The computer, I think it stands for Computer Exchange. And not only have they got high street stores, you can also send your games to them free post. Failing that, you can also use eBay or Facebook Marketplace. All of these places, you're going to get some really good value trade-in prices for your games. So Damien, let's get to the games. This is the kind of exciting bit for you. Nintendo is where the money's at. That's where it holds value. So have you got any old Nintendos? Any DS, Wii's?
I've got a DS, I think. I wasn't really a Nintendo fan. I was more of a Sega Mega Drive kind of guy.
Yeah, unfortunately, I'm going to burst your bubble a little bit. Sega isn't so popular. Nintendo is where the money is at. But you can still get good money on PlayStation titles and a few things like that. But Sega, unfortunately...
Give us a top 10. Run through it.
So Jordan's broken it down in various different titles. So Mario is where it's at, and that's on various different formats on generally Nintendo, because Mario and Nintendo are synonymous with each other. So if you've got any Mario Kart games on either the DS or Wii, you're going to be looking at around about £8 to £25 even now. I mean, those games are about 7, 8, 10 years old, some of them. So yeah, between sort of £8 and £25.
That's pretty good. Quite impressed by that.
And then you start looking at Super Mario Brothers, Mario Party, Super Mario Galaxy. All of these games are somewhere between £5 and £20 on either the DS or the Wii is generally where the money's at. Now, I'm pretty astounded by that, because the value of those games that is holding in what is now probably 10 years since some of those titles were released is pretty decent. I know people that have got maybe 10 different Mario titles on a DS. I mean, you're sitting on £250 there, potentially. It's crazy.
So the message is, we're going to publish Jordan's article and you can find out more information to go and have a look at it and therefore be inspired by the amount of money you could get. And does he explain where he found those prices?
Yeah, so those prices are the average price on both Computer Exchange and eBay, but you can also get similar prices on Facebook Marketplace, but you need to be a bit more patient. On eBay and Computer Exchange, you can get the money pretty much straight away, but on Facebook, if you want to get the price you're looking for, you're going to have to hold out. You're going to have to wait 2, 3, 4 weeks until it becomes popular. But yeah,
I love that. So if anybody wants to know more, then they can look at Jordan's article that will be published by the time this podcast goes out. So I think that's it for this week, isn't it, Andy? We're done.
That's it. We are done. If you want to get in touch with Damien, you can do so as normal. It's Damien at moneytothemasses.com. That's the email address. Twitter, it's at moneytothemasses with the number 2. Don't forget, we have got the Money to the Masses community group, which is growing by the hundreds each week. So do get involved on that. That's facebook.com/groups/money to the masses. And of course, if you can review the podcast, that would be absolutely amazing. It's probably going to be mug worthy, which means when we get out of all this, we'll be sending you out a coveted Money to the Masses mug.
Great. Until next time.
Until next time.